are going to extend our conversation from video 2, all the algebra we did for the upper-lower bounds. We're going to extend it now, and we're going to focus primarily on the European call and the European put. And then we're going to derive a relationship from what we've already done. So let's start with a European call. And over here we'll put the put. And for this example, the strike price will be the same for both the call and the put, and the time to expiration will be the same for the call and the put. And we're going to design a portfolio here combined with the call and something combined with the put and work our way forward. So if we have a call and we want to exercise the call, we will need, remember for European options, it's last day expiration. So on the last day, we will need the strike price. We will need K. And this, of course, is time T. So what we're going to need today is an investment that will grow to K in time T. So this we'll call a zero coupon bond. Remember, the zero coupon bond is nothing more than a non-interest paying or non-coupon paying bond. We simply buy it at a discount and it matures at its face value, the face value here being K. So we're going to have a long call plus a zero coupon bond. And on this side, we're going to buy the put. And in buying the put, we're going to pair it with the stock itself. So we're long the stock. We have a long position in the stock, and we have a long put with the same strike price as the call that expires in the same amount of time. So let's have a look at what the final values of these will be. If the final stock price is greater than the strike price, we will exercise our call. This will mature at K. We'll use the strike to buy the stock, which means that the value of this portfolio will be ST. If, on the other hand, the stock price is less than the strike price, this will expire worthless, but this will have grown to the face value of K. That's what we'll have left. The value of this portfolio will be K. So the value at time T will be the maximum of either the stock price or the strike price. Now notice I'm not saying the profit. We don't know what the profit is. We could still end up with a loss. We're just really looking at the value of what this is going to be at time T. Let's head over here and have a look. Let's ask the same question. If the final stock price is greater than the strike price, what will we do? Well, we certainly won't use the put. Our long position in S0 will be ST. So it'll be worth ST. If, on the other hand, the stock price is less than the strike price, what will happen? Well, if the stock price fell, we'll exercise the put and realize the strike price, which is K. So the value of this portfolio at time T is the maximum of either the stock price itself or the strike price. Well, what we have here are two portfolios with identical future values. If the stock price is above the strike price in both conditions, we'll have the stock price. If the stock price is below the strike price in both conditions, we'll have the strike price. So if they have the same future value, for there to be no arbitrage opportunity, and remember arbitrage opportunity is a risk-free opportunity that provides a return above the risk-free rate. There'd be no arbitrage, no risk-free opportunity here when their present value are identical. So that means today they must be the same. So let's have a look at what that means. That means that the call plus the zero coupon bond must equal, the value of this today must equal the stock plus the value of the put. So let's just get an example in here, and let's see what we can where we can go with that. And what I'm going to show you is, if we know the price with this formula, if we know the price of any one of these two options, we'll always know the strike, right? We'll always know that. The stock price, we'll always know that too. But if we have only one price, a price on a call, from that we can determine what the price of the put will be. If we have the price of the put, we can determine what the price of the call will be. So let's just get an example down here. Let's let the stock price equal to 31. Let's get a strike price of 30, an interest rate of 10%. Our T will equal 3 months, and let's say that our call price is $3. If that were the case, how much is the put? Well, all we have to do is just substitute, right? 3 plus 30, e to the negative 0.10 for 0.025, must equal 31 plus the value of the put. This simplifies to 32.26 equals 31 plus the value of the put. Doesn't take much algebra at that point to see that the value of the put is 126. So we know the value of the put. This relationship, by the way, when we're talking about the same strike price and the same time to expiration, and this is independent of the stock price. It's independent of the stock price. So let me tell you what that means before we go any further, so you have a good idea. Let's say that here we go. Let's say that here's the strike price, and we'll put the stock price up here. If we have a call and a put at the same strike price, this relationship holds. If the stock price were here, if the stock price were here, if the stock price were here, or if the stock price were here, this relationship still holds. In other words, if the stock price is here and you can move the strike price up or down so that the call and the put have the same stock price, the same strike price, this relationship holds. And this relationship is called, it has a name, it is called put call parity, which is a very important relationship in options, because from it we can derive some very important positions, and I'm going to get to that very shortly. But it is usually around this point that when you do the big ta-da, look what we have here, look what we've done, that somebody somewhere, some student puts their hands up with a question. And it's a valid question once we get to this point and we realize that we can determine the price of any one option from the price of the other. Somebody asks, and like I say, it's valid, so what? Big deal. So what? Is that it? All of this work, all of that for that? Well, let me give you the answer to that. There are two answers to the so what. The first answer has to deal with what marketplace you're living in. If we're talking about exchange-traded options, then yeah, the so what could be valid, because you could always say, look, I can always just look up the price of the put. The put will be right there. I could just look it up. I don't have to go through all of this math. It's already there. Okay, great. But what if you're dealing with the OTC market? What if you're not dealing with standardized options, but what if you're financially engineering an option? Well, in that case, you have to derive the value of a call or the value of the put. And in knowing the value of the call, you can easily determine the value of the put at that same strike. So that's important. That's important to know how to do. The other side of it is, okay, let's go back to the exchange-traded options. Once we've done all of this, so what? Well, let me extend this example a little bit, and let's see what happens when we change something here. So let's say we'll say, what if our stock price went to $32? So we said here that it was 31. Now we're going to see what happens when it goes to $32. Is there anything we can say about the call and the put, or the relationship between the call and the put based on what we've learned here? Well, recall that it's written right here, but I'm going to rewrite it again, that the call plus the zero coupon bond must equal the stock price plus the value of the put. So let's just rearrange some terms here. Let's take put the options on this side and the assets on this side. So CE minus PE, to get P to this side, must equal S naught minus the zero coupon bond. Well, there's something that we can find here that simplifies things a little bit. This term is a constant. This term does not depend on the value of the stock price. So if the stock price went up by $1, the strike price stays the same. E is a constant term. The interest rate stays the same. And our time to expiration may have changed slightly, but let's just say that it went from 31 to 32 today, so that T is the same. This is a constant. So as the stock price changes, this does not change at all. And since the two sides must be equal, we can then take the next step to say any change in one side, so if the stock price changes, and since this is a constant, any change in a constant is zero, so that's why we can eliminate it. Any change in the stock price must be met with an equal change on the other side, so that the change in the value of the call plus the change in the value of the put must equal the change in the value of the stock. Well, let's go back to our first video. What do we know? Let's recall. This is just a recall. When the stock price increases, what happens to the value of calls and puts? When the stock price increases, the value of a call increases, the value of a put decreases. So we can use that over here, so that when the stock price increases, the call price will increase, the put price will decrease. And by the way, I'm sorry, I have to change something here so that we don't get too confused. I erroneously put a plus sign in there. When expanding it, as you can clearly see inside there, it should have been a minus sign. So the call will increase in value, the put will decrease in value. But look at here, you have a minus and negative, which makes it a positive. So I got confused, that's why I put the plus sign in. We'll see that these two changes are additive. They are additive, we don't subtract them. If this holds here, the other relationship must hold, that if the stock price drops, the put value increases, the call value decreases. So what we want to do is we want to try to rewrite this so that it incorporates both movements without having to figure out which way it went. And it's very easy to do by just taking the absolute value of the change in the value of the call plus, and there's our plus sign now, the absolute value of the change in the value of the put must equal the absolute value of the change in the stock price. So if the stock price goes up $1, the change in the call plus the change in the put will equal, notice this is a hard equal sign, will equal the change in the stock price. It will equal the change. So we can use options to create a payoff that is identical to the stock. And what have we got here? Well, since this is a call, we are long a call. This is a put, but we have a negative sign in front of it, so we need to be short a put. So a long call plus a short put at the same strike with the same amount of time to expiration will equal, is the same as the underline. You create the same payoff chart. And there's a name for this. There is a name for this. This is called a synthetic long, a synthetic long. Synthetic because we've used options to create it. So now we've covered the two broad categories, or the two broad reasons why we use options. Number one, risk management. We see that. We know that we can get risk management from options. The second one, which we've seen here, is to create synthetic exposure. And that's what we have. Let me recap what we ended with in the last screen. We had a long call. This was very exciting, wasn't it? A long call plus a short put. In other words, we're long a call, we're short a put, and we found that it equaled the stock. And that we referred to as a synthetic long position. Well, if we travel through with a negative sign, and we put a negative sign in front of everything, our long call would turn into a short call. So we can short a call, and we would be then long a put, must equal negative S. So what we have is a short call and a long put is a synthetic short. So we can create a long position using two options, and we can create a short position using two options. And this is entirely a result of put-call parity. And put-call parity means that the put and the call occur at the same strike price for the same period of time. They have the same expiration date and the same strike price. Now this is independent of the stock price, and let me show you what I mean. Let's say that the stock price is over here, and you take a strike price down here, and you buy a call, and you sell the put. You have a synthetic long. If you take this strike price instead, it holds. You have a synthetic long. If you take a strike price up here instead, it holds, and you have a synthetic long. It doesn't matter what strike price you choose, as long as it's the same strike price for both and the same time to expiration. Now, down here, if the stock price is here, the call is deep in the money, so you'll pay a lot for the call and not so much for the put. But up here, the call is out of the money, so you'll pay a little for the call, but the put is in the money, so you'll pay a lot for the put. So the price of each one can be, if we know the price of one, we can derive the price of the other. And it doesn't matter where the strike price is in relation to the stock price. These synthetic positions hold with strict equality. Strict equality. So we can say that this is strict put-call parity. And I'll write that down for you. Strict put-call parity. Now, what about American options? That seems to be the more relevant question, since most of the exchange-traded options on equities we'll be dealing with are American-style options. Will this work? Does this hold? The answer to that is in two parts. Strictly speaking, no. Usefully speaking, yes. Yes, it holds enough to be useful, but we cannot talk about strict put-call parity. And it sort of breaks down like this. Look up here for the synthetic long on the European call and the European put. The long call plus a short put equals the stock. So any change in the stock is met by an equal change, an equal magnitude in the change of these. So it's penny for penny for penny, period. On the American side, however, the value of the call, an American call, plus the value of the American put, any change in the value of these will be somewhat equal to the change in the stock price. And by somewhat equal, I mean we can even put a little greater sign in here saying it's kind of equal to a little greater than. I know this is not a really good mathematical symbol, but the top part of the symbol means it's somewhat, approximately equal, approximately to greater to. So let's take an example, and let's say that this goes up by $1. The change in the call and put will go up by a little more than $1, but not much. It'll be somewhere around $1.01, and I've seen it as high as $1.04, $1.05. We're not talking like $1.20, $1.30, $1.40, nothing like that, but it's very, very close. And sometimes it is actually just $1, but it's not strict. By that, I mean that it's never always going to be $1, but it'll jiggle around the dollar mark. And so, as far as strict put-call parity goes, no. So, given the price of an American call, given the stock price, given the interest rate, the time to maturity, and the strike price, you cannot determine the price of the call. But what you can do is you can determine a range in which the value of the put will be. Much like if we know the value of the put and everything else, we can determine a range in which the call price will be, but not an exact number. So strict put-call parity is for the European options, not for the American options. But even though we don't get strict put-call parity in determining the price of one from knowing the other, it is useful enough to still create synthetic positions on American-style options. And it is a very popular strategy to do. Now, before I leave you, let me give you a little bit of let me bring you into the real world a little bit. Let's say that there is a stock that has a price of $50, and I'm just going to make it 50 so that I can give you a strike price at the same price. And let's say we're going to take a strike price at $50, and our time is going to be 6 months. You will find that the vast majority of the time that what you buy a call for, an American call, if you're long the call, what you buy the call for will be very, very close, if not equal, to what you sell the put for. So now think about this. When you buy a call, it is costing you money. You're going to send money out of your bank, out of your brokerage account. When you sell the put, money is going to come into your brokerage account. The money going out is very close to the money coming in, which can sometimes get you to a net zero cash flow position. What that means is that you can create a synthetic exposure to an equity, both on the long and the short side, by selecting a strike price as close to the stock price as possible and pay nothing. Pay nothing for it and still realize the same payoff as if you had bought the underlying. Isn't that powerful? So that somebody starting their trading career, and I call it entrepreneurial trading, if you're going to set up your own trading account and trade for a living, which many people do, that it's a respected profession. There's lots of New York and Chicago traders that do exactly that. If you're going to do that and all you have is $25,000, well, in equities, you're not really in business. You're not going to make a living. You're not going to do much. But in options, you can create synthetic exposure to those very equities that would normally cost you more to buy for sometimes as low as 8 to even 15%. And I'm talking about the margin now, anywhere from 8 to 15% of what it would normally cost you. So if you figure that you can lever up 10 times, your $25,000 will create $250,000 worth of exposure in the options market. Now, I'm not saying go ahead and lever all the way up 10 times. I'm just saying that by using the synthetics, by using put-call parity, you can create a payoff that is the same as owning or shorting the stock without the size of the investment required. A smaller investment for the same payoff. Think about what that means. I have one more video lecture to do in Chapter 11 where I'm going to go into a little bit more detail about this right here, these bands. And you're going to see how the difference in the pricing of European and American calls and puts relates to the difference in this put-call parity.